Chapter 1 Introduction 1.1 Why Syndicated Loans Matter. Large corporates, sovereigns, and financial sponsors often need financing amounts that exceed the risk appetite of a single bank. Syndicated loans allow multiple lenders to share a single credit exposure while presenting one loan to the borrower, coordinated through an agent bank. This structure spreads risk, deepens client relationships, and creates fee and interest income opportunities across a network of banks. For growing mid-market and large corporates, syndication is often the most efficient way to secure flexible, multi-year funding in different currencies and tenors. For lenders, the syndicated market has become a core source of assets that can later be traded or securitized into structures such as CLOs, further enhancing balance sheet flexibility. 1.2 The operational reality behind one loan. From the borrower's perspective, a syndicated facility looks like a single relationship with an agent bank, a single set of documents, and a coordinated set of drawdowns and repayments. Behind the scenes, however, the operational reality is far more complex. Multiple lenders, multiple tranches with different economics, and potentially dozens or hundreds of parallel drawdowns over many years. Every change in interest rate, repayment, or amendment must be correctly reflected for each lender, currency, and tranche. The agent bank stands at the center of this complexity. It must coordinate cash flows, notices, calculations, and documentation in strict alignment with the facility agreement, while maintaining accurate positions and accounting records for each lender in the syndicate. Doing this at scale across thousands of deals is impossible without a specialized syndicated loan servicing platform. 1.3 Enter Finastra Loan IQ. Finastra's Loan IQ is widely recognized as the market-leading commercial and syndicated loan servicing platform. It processes roughly 70% of the world's syndicated loans and supports the full lifecycle from deal setup through servicing, trading, and settlement. Leading global and regional banks deploy Loan IQ to consolidate multiple legacy loan systems onto a single platform and to standardize best practices across their portfolios. Loan IQ provides rich functionality for deal structuring, servicing, and accounting of both syndicated and bilateral loans. It supports complex structures such as multi-currency tranches, revolving credit facilities, term loans, and project finance deals, while integrating with upstream origination tools and downstream general ledger, payments, and reporting systems. Because of this breadth, understanding how Loan IQ represents deal, tranche, and drawdown reality is a key skill for operations, IT, risk, and transformation teams. 1.4 Who this ebook is for. This ebook is designed as a practical, system-focused guide for four main audiences: business users, corporate bankers, agency operations staff, loan administrators, and middle office teams who work daily with syndicated loans and Loan IQ screens. Credit and risk professionals, analysts, and portfolio managers who need to understand how structures and covenants in the facility agreement translate into system behavior and risk data. Technology and architecture teams, business analysts, solution architects, developers, and integration engineers responsible for implementing, enhancing, and integrating Loan IQ. Production support and transformation leads, teams who keep Loan IQ running, manage change, and lead migrations or process automation initiatives. No prior Loan IQ experience is strictly required, but basic familiarity with corporate lending and syndicated loan terminology will help you get more value from each chapter. 1.5 What this ebook will help you do. By the end of this ebook, you should be able to read a syndicated facility agreement and mentally map its structure to Loan IQ, which parts belong at the deal level, which at tranche level, and which at contract or drawdown level. Understand the full life cycle of a Loan IQ booked syndicated deal from mandate to maturity, including drawdowns, rollovers, prepayments, amendments, and events of default. Navigate key Loan IQ objects and screens and recognize how data flows between them across the lifecycle. Design and validate practical configurations for common structures such as term loan tranches, revolving facilities, and project finance deals. Speak a common language with IT, operations, and risk teams about integration points, controls, data quality, and performance when running Loan IQ at scale. Throughout the book, we combine conceptual explanations with concrete examples, lifecycle walkthroughs, and case study exercises to make the material practical and directly applicable in real projects. Chapter 2 Syndicated Lending Fundamentals. 2.1 Key Parties. Arranger, bookrunner, agent, lenders, borrower, trustee. Syndicated loans involve a complex interplay of various parties, each with distinct roles and responsibilities. Understanding these roles is crucial for comprehending the mechanics of syndicated lending. Arranger, the bank or banks responsible for originating the loan, structuring the facility, and syndicating it to other lenders. They often take on significant underwriting risk. Bookrunner, the bank or banks that manage the syndication process, including marketing the loan to potential lenders, allocating commitments, and maintaining the book of lenders. Agent or facility agent, the bank appointed to administer the loan throughout its lifecycle. This includes managing drawdowns, repayments, interest calculations, fee collection, and communication between the borrower and the syndicate. The agent acts on behalf of the lenders. Lenders or participants, the financial institutions such as banks and institutional investors that provide the capital for the syndicated loan. They commit to a portion of the overall facility. Borrower, the corporate, sovereign, or financial sponsor receiving the financing. Trustee, in some structures, particularly those involving securitization or complex collateral arrangements, a trustee may be appointed to hold security on behalf of the lenders. 2.2 Facility agreements. Facilities, tranches, covenants, events of default. The facility agreement is the cornerstone legal document governing a syndicated loan. It outlines the terms and conditions under which the loan is provided. Facilities. These are the distinct credit products offered under the agreement. Common types include term loan, a loan with a fixed maturity and a predetermined repayment schedule. Revolving credit facility, a flexible facility that allows the borrower to draw down, repay, and redraw funds up to a certain limit over a specified period. Letters of credit and guarantees, which are non-cash facilities that provide credit support. Tranches. Within each facility, there can be multiple tranches, which are subdivisions with different economic terms such as different currencies, interest rates, maturities, or lender groups. For example, a term loan might have a term loan A and a term loan B with varying amortization profiles. Covenants. These are promises or restrictions placed on the borrower to protect the lender's interests. They can be financial covenants, which are ratios or metrics the borrower must maintain like debt to EBITDA or interest coverage ratio. Affirmative covenants, which are actions the borrower must take such as providing financial statements or maintaining insurance. Negative covenants, which are actions the borrower must not take like incurring additional debt beyond certain limits or selling key assets. Events of default. Specific occurrences that, if triggered, allow lenders to demand immediate repayment of the loan or take other remedial actions. Common events include non-payment, breach of covenants, insolvency, or cross-default with other obligations. 2.3 Economic building blocks. Margins, fees, interest periods, day count, calendars. Several key economic elements determine the cost and structure of a syndicated loan. Margins. A spread added to a benchmark interest rate like SOFR or Euribor to determine the all-in interest rate paid by the borrower. Margins often vary based on the borrower's credit rating or leverage. Fees. Various charges associated with the loan, including arrangement fees paid to the arrangers for structuring and syndicating the loan, commitment fees paid on the undrawn portion of a revolving facility, agency fees paid to the agent bank for administering the loan, utilization fees sometimes charged on drawn amounts, particularly for revolving credit facilities. Interest periods. The frequency at which interest is calculated and paid, such as 1 month, 3 month, or 6 month. At the end of each interest period, the interest rate is reset based on the prevailing benchmark rate plus the margin. Day count conventions. Rules used to calculate the number of days in an interest period for interest accrual purposes like actual over 360, 30 over 360, or actual over actual. These conventions impact the precise interest amount. Calendars. Business day conventions and holiday calendars are used to adjust payment dates and interest period end dates to ensure they fall on business days in relevant financial centers. 2.4 Typical syndicated structures. Syndicated loans come in various structures tailored to specific borrower needs and market conditions. Term loans are generally amortizing loans with a fixed repayment schedule. They can be further divided into Term Loan A, often syndicated to banks, typically with shorter maturities and more aggressive amortization. Term Loan B, often syndicated to institutional investors, with longer maturities, bullet repayments, and often covenant-light features. Revolving credit facilities provide flexible, short-term funding. Borrowers can draw, repay, and redraw funds as needed up to the facility limit. They are crucial for managing working capital. Term loan plus revolver is a common combination where a term loan provides long-term capital and a revolver offers liquidity for day-to-day operations. Project finance is highly structured, non-recourse or limited recourse financing for large-scale infrastructure or industrial projects. These loans are repaid from the cash flows generated by the project itself and involve complex security and intercreditor arrangements. 2.5 From mandate to signing. High-level lifecycle. The syndicated loan process typically follows a structured lifecycle. First, mandate. The borrower awards a mandate to one or more banks to arrange the syndicated loan. Second, structuring. The arrangers work with the borrower to design the loan structure, including facilities, tranches, pricing, and covenants. Third, underwriting. The arrangers may underwrite the entire loan, committing to provide the full amount and then selling down portions to other lenders. Fourth, syndication. The arrangers market the loan to potential lenders, inviting them to participate. This involves preparing information memoranda and conducting roadshows. Fifth, commitment. Lenders commit to provide a certain amount of the loan. Sixth, allocation. The arrangers allocate the committed amounts among the participating lenders. Seventh, documentation. Legal counsel drafts and finalizes the facility agreement and other related documents. Finally, signing. All parties sign the facility agreement, making the loan legally binding. Chapter 3 Overview of Finastra Loan IQ. 3.1 Why banks use Loan IQ. Global and regional banks run very large, complex syndicated and commercial loan books. They need a platform that can consistently handle thousands of deals, multiple currencies, multiple booking entities, and many decades of lifecycle events. Loan IQ was designed precisely for this world. It is a specialized loan servicing system, focused on complex bilateral and syndicated lending rather than retail or small business loans. Key reasons banks adopt Loan IQ include consolidation of legacy systems, as many banks operate with a patchwork of older, disparate systems. Loan IQ allows them to consolidate these onto a single, integrated platform, reducing operational costs and complexity. Standardization of best practices. By centralizing loan servicing, banks can enforce consistent processes and data standards across their global operations. Comprehensive lifecycle support, from deal origination and setup through servicing to trading and settlement. Handling complexity, as the platform is built to manage the intricate details of syndicated loans, including multi-currency tranches and complex interest calculations. Risk management and compliance, with robust capabilities for tracking credit exposure and managing covenants. And finally, scalability, as the system is designed to handle a high volume of transactions and a large number of deals. 3.2 Positioning Loan IQ in the lending architecture. Loan IQ typically sits as a core component within a bank's broader lending technology architecture. It integrates with various upstream and downstream applications. Upstream integration includes origination systems, front office platforms where deals are initiated and structured, KYC systems for client onboarding and due diligence, and limit management systems to check and manage credit limits before deal booking. Downstream integration includes general ledger for posting accounting entries, payment systems for initiating and receiving cash flows, treasury systems for managing funding and liquidity, data warehouses and reporting systems for business intelligence and analytics, and risk management systems for feeding data on exposures, collateral, and covenant compliance. 3.3 Core capabilities for syndicated loans. Loan IQ offers a rich set of functionalities specifically designed for syndicated loan servicing. Deal and tranche structuring, lender management, interest and fee calculation, drawdown and repayment processing, amendments and waivers, covenant tracking, agency operations, reporting, and secondary trading. 3.4 Technology and deployment options. Finastra Loan IQ has evolved to offer flexible deployment options. On-premise, traditionally deployed on a bank's own servers for maximum control. Cloud deployment, leveraging public cloud providers to reduce infrastructure costs and improve scalability. And managed services, where Finastra or a third-party provider manages the application and infrastructure entirely. 3.5 Navigating the user interface and major modules. Loan IQ's user interface provides comprehensive access to deal and loan data. Key modules typically include deal management, contract management, lender positions, cash management, accounting, covenant management, reporting, and reference data management. Understanding the flow of data between these modules is key to efficient operation. Chapter 4 Loan IQ Object Model. Deal, Tranche, and Drawdown. For point 1 Conceptual Hierarchy. Loan IQ organizes syndicated loan data into a hierarchical object model that mirrors the structure of a facility agreement. Understanding this hierarchy is fundamental. Deal is the highest level, representing the entire syndicated financing arrangement. It groups all related facilities and tranches for a single borrower. Facility is a specific credit product within the deal, such as a term loan or revolving credit facility. Tranche is a subdivision of a facility with distinct economic terms, like different currencies or interest rate margins. Contract represents an individual loan agreement or sub-agreement under a tranche. And drawdown is the lowest level, representing an individual disbursement of funds. For point 2 Key data elements. Each level holds specific data. Deal level includes the name, borrower, signing date, and agents. Facility level includes the type, total commitment, and availability periods. Tranche level includes the currency, limit, maturity, pricing, and lender commitments. Contract level includes the contract ID and links to the tranche. Drawdown level includes the amount, date, interest period, and applied rate. For point 3 Storing pricing, fees, and covenants. Pricing components like base rate index and margin are typically stored at the tranche level. Fees can be configured at various levels from deal to individual lender. Covenants are tracked at the deal, facility, or tranche level, with functionality to define types, set thresholds, and record compliance status. 4.4 Multi-currency and multi-entity considerations. Loan IQ handles international complexities. Multi-currency allows each tranche to be in a different currency, manages exchange rates, and provides data for hedging. Multi-entity allows a deal to be booked across multiple legal entities or branches, managing intercompany loans and consolidated reporting. For point 5 Mapping example. Consider Alpha Manufacturing Limited with a $300 million term loan A and a $200 million revolving credit facility. At the deal level, we have the overall facilities for 2026. At the facility level, we define the term loan and revolver separately. At the tranche level, we set the specific USD limits, maturities, and pricing for each. Finally, at the drawdown level, each actual use of funds is recorded with its specific amount and date. This structure helps you map any facility agreement directly into Loan IQ. Chapter 5 Setting up a syndicated deal in Loan IQ. 5.1 Prerequisites and reference data. Before touching the new deal screen, several foundations must be in place. This includes party and account setup for borrowers, guarantors, and lenders. Product and parameter readiness, ensuring templates for syndicated loans are approved and reference data like interest rate indices are updated. Organizational and limit checks to confirm credit approvals and booking entities. And finally, documentation readiness, having the facility agreement available to drive core economic terms. 5.2 Creating the deal shell. The first hands-on step is creating the deal shell. This involves basic identification like the deal name and ID, assigning roles for agents and arrangers, setting key dates like signing and maturity, and defining high-level attributes like the booking entity. 5.3 Adding facilities and tranches. Once the shell is ready, you define the facilities such as term loans or revolvers, including their limits and availability periods. Then, you configure the tranches, setting the currency, amount, tenor, and specific interest and fee parameters. 5.4 Capturing lender commitments. A syndicated deal is defined by its lenders. You must define the lender group, enter their commitments by tranche, and record voting rights and fee allocations. Once captured, Loan IQ automatically generates positions and calculates each lender's share. 5.5 Validations and controls. Setting up a deal is high stakes. Banks use maker-checker workflows and standard checklists to ensure accuracy. Common errors to watch for include limit mismatches, pricing misconfigurations, calendar errors, and lender assignment issues. A best practice is to perform a dry run of key lifecycle events like a test drawdown to verify calculations and accounting before the deal goes live. Chapter 6, Tranche Design and Configuration. 6.1 Tranche Types. Loan IQ supports various tranche types, including term loan tranches, revolving credit facility tranches, delayed draw term loans, CAPEX tranches, and letter of credit or guarantee tranches. Understanding these is critical for accurate system configuration. 6.2 Tenors and Amortization. Tenors define the maturity period, while amortization profiles determine the repayment schedule. These can be bullet repayments, straight-line amortization, sculpted amortization for project finance, or custom schedules. 6.3 Pricing and Fee Setup. Accurate pricing at the tranche level is paramount. This includes the base rate index like SOFR or Euribor, the margin, and any floor or cap fee types like commitment, utilization, agency, and upfront fees are also configured here with specific calculation methodologies. 6.4 Covenants and Conditions. Many covenants are specific to individual tranches, such as financial covenants like debt service coverage ratios. Conditions precedent and specific undertakings or restrictions are also tracked at this level, with monitoring and alerts for compliance. 6.5 Case Study. A. B tranches. For a $500 million corporate loan, we might design a term loan A for commercial banks with a 3-year maturity and quarterly amortization, and a term loan B for institutional investors with a 5-year maturity and a bullet repayment. Loan IQ allows for this granular configuration under a single facility to cater to different lender appetites. Chapter 7 Lender Positions, Allocations and Voting. 7.1 Understanding Positions. In syndicated lending, a position is a lender's share of a loan or tranche. Loan IQ tracks these for accurate accounting and fee distributions. Subpositions can also be tracked for complex scenarios, like when a lender participates through multiple internal entities. 7.2 Primary Allocations and Secondary Trading. Primary allocations establish each lender's initial commitment. Secondary trading allows lenders to sell their positions. Loan IQ must reflect these transfers, updating ownership records and reallocating future cash flows to the new lender. 7.3 Voting and Decision Events. Loan agreements include provisions for collective decision-making. Loan IQ supports this by tracking voting thresholds, like simple majority or unanimous consent, and recording lender votes for decision events. 7.4 Handling changes in the syndicate. Loan IQ manages the onboarding of new lenders, the exit of lenders who sell their entire position, and sell downs where a lender reduces its exposure. 7.5 Operational pitfalls. Managing positions is prone to manual entry errors, mismatches between legal and system records, and timing issues. Robust controls, maker-checker processes, and regular reconciliation are essential to maintain data integrity. Chapter 8 Drawdown Lifecycle in Loan IQ. 8.1 Drawdown Requests and Conditions Precedent. The drawdown process begins with a formal request from the borrower. Before funds can be disbursed, several conditions must typically be met. These include legal opinions, financial covenants, representations and warranties, and documentation. Loan IQ allows for the tracking and management of these conditions, ensuring that no drawdown is processed unless all necessary requirements are met. 8.2 Rate Setting and Fixing. Once a drawdown is approved, the interest rate for the upcoming period must be determined. The borrower typically chooses an interest period, such as 1 month, 3 month, or 6 month. On the rate fixing date, Loan IQ retrieves the prevailing benchmark rate, such as SOFR or Euribor, and adds the applicable margin to determine the all-in interest rate. 8.3 Funding mechanics and cash flows. After rate fixing, each participating lender funds its pro rata share of the drawdown amount to the agent bank. The agent bank then consolidates the funds and disburses the total amount to the borrower. Loan IQ generates the necessary accounting entries and payment instructions for these cash movements. 8.4 Rollovers, conversions, and restructurings. Over the life of a loan, drawdowns may undergo various changes. Rollovers involve refixing the interest rate for a new period. Conversions might involve changing the currency or interest rate basis. Restructurings involve changes to maturity dates, interest rates, or repayment schedules. 8.5 Drawdown history and audit trail. Loan IQ maintains a comprehensive history of all drawdown-related events. This audit trail is critical for transparency, reconciliation, compliance, and troubleshooting, ensuring full traceability throughout the loan's lifecycle. Chapter 9 Repayments, Prepayments, and Repricing. 9.1 Scheduled repayments. Scheduled repayments are a fundamental aspect of term loans. Loan IQ manages these based on the amortization profile configured at the tranche level. For amortizing tranches, Loan IQ generates a schedule of principal repayments, which can be equal installments, increasing or decreasing installments, or custom schedules. Interest is typically paid concurrently with principal repayments. 9.2 Voluntary and mandatory prepayments. Borrowers may repay loans ahead of schedule. Voluntary prepayments are chosen by the borrower to reduce interest expense. Mandatory prepayments are required by the facility agreement upon certain events, such as asset sales or excess cash flow generation. Loan IQ processes these, calculating any applicable penalties or breakage costs. 9.3 Repricing events and margin changes. Loan terms, particularly interest margins, can change over the life of a loan. Repricing events occur when the interest margin is reset based on predefined criteria like changes in the borrower's credit rating. Margin changes can also occur as part of a broader amendment to the facility agreement. 9.4 Impact on lender positions and cash flows. Repayments, prepayments, and repricing events directly impact lender positions and future cash flows. They reduce the outstanding principal balance, altering lender exposure, and affect future interest accruals and fees. 9.5 Accounting and reconciliation. Every repayment, prepayment, and repricing event generates accounting entries. Loan IQ integrates with the general ledger to ensure accurate financial reporting. Regular reconciliation of principal and interest with lenders and borrowers is essential to identify and resolve discrepancies promptly. Chapter 10 Amendments, Waivers, and Events of Default. 10.1 Typical amendment types. Syndicated loan agreements are living documents. Common amendments include maturity extensions, margin adjustments, covenant modifications, facility or tranche changes, borrower or guarantor changes, and administrative corrections. 10.2 Capturing amendments and waivers. Loan IQ provides functionality to record these changes, ensuring the system reflects current legal terms. This includes amendment processing with effective dates and specific term changes, recording waivers for covenant breaches, and maintaining a history of all amendments through version control. 10.3 Events of default and acceleration. An event of default is a serious breach. Loan IQ tracks potential defaults and can generate alerts. Upon a default, lenders may choose to accelerate the loan, demanding immediate repayment. Loan IQ processes this acceleration, updating schedules and generating accounting entries. 10.4 Keeping documentation and system aligned. A critical challenge is ensuring perfect alignment between legal documents and system records. This requires thorough manual reviews, robust audit trails to track changes, and strict process controls like maker-checker workflows. 10.5 Lessons learned. Experience shows that amendments are often more complex than initial setup. Clear communication between legal, front office, operations, and IT teams is paramount. Thorough testing in non-production environments and standardizing amendment types can significantly reduce errors and processing time. Chapter 11 Agency Operations and Reporting. 11.1 Role of the facility agent. The facility agent plays a central role in the day-to-day administration of a syndicated loan. Their responsibilities include acting as a communication hub between the borrower and lenders, managing all cash flows, distributing notices and financial statements, performing calculations for interest and fees, and maintaining accurate records. Loan IQ provides the tools for the agent to perform these high-volume tasks efficiently. 11.2 Notices and communications. Effective communication is vital. Loan IQ facilitates the generation and distribution of drawdown notices, interest rate notices, payment notices, event notices for covenant breaches, and confirmations for transactions like secondary trades. Many of these can be automated to ensure consistency. 11.3 Payment waterfalls. In complex structures like project finance, the facility agreement may specify a payment waterfall. This dictates the strict order in which cash flows are applied to obligations. Loan IQ can be configured to support these waterfalls, ensuring funds are allocated according to the agreed-upon priority. 11.4 Standard operational reports. Loan IQ generates essential reports for operational management, including loan position reports, cash flow forecasts, past due reports, transaction reports, and audit reports. These are critical for daily operations and internal oversight. 11.5 Regulatory and management reporting. Loan IQ data is a key input for regulatory reporting obligations like Basel III and IFRS 9. It also feeds into management information systems for portfolio analysis and risk modeling. The accuracy and completeness of data in Loan IQ are paramount for these reporting requirements. Chapter 12 Integration Landscape and Automation. 12.1 Upstream integration. Loan IQ is rarely a standalone system. Its effectiveness is enhanced through integration with upstream systems like origination and deal management systems, which flow data into Loan IQ to initiate deal setup. KYC and client onboarding systems ensure all entities are properly vetted. Limit management systems verify that proposed exposures do not breach credit limits. 12.2 Downstream integration. Equally important are integrations with downstream systems. The general ledger receives accounting entries for all movements. Payment systems receive instructions for disbursements and payments to lenders. Treasury systems use data on future cash flows for liquidity management. Data warehouses and business intelligence platforms consume Loan IQ data for analytics and reporting. 12.3 Loan IQ Nexus and API connectivity. Finastra's Loan IQ Nexus provides a suite of APIs for modern integration. This API-first approach offers flexibility for custom development, real-time data exchange, reduced complexity compared to older methods, and enables a broader ecosystem of applications. 12.4 Event-driven automation. Modern implementations leverage event-driven architectures to automate processes. This includes automated notifications for rate fixes or payment due dates, workflow orchestration for complex processes like drawdown approvals, and robotic process automation for repetitive tasks. 12.5 Design patterns for robust integrations. Successful integrations follow patterns like loose coupling to minimize impact between systems, robust error handling and reconciliation, scalability for high volumes, strong security for sensitive data, and proactive monitoring of integration flows. Chapter 13 Controls, Risk and Data Quality. 13.1 Maker-checker and segregation of duties. Robust internal controls are paramount. Loan IQ supports these through the maker-checker principle, where one individual initiates a transaction and another reviews and approves it. Segregation of duties is implemented through role-based access control, ensuring no single person has control over all stages of a transaction, which prevents conflicts of interest and unauthorized activities. 13.2 Parameter governance and product catalog management. Loan IQ relies on configurable parameters like interest rate indices and fee types. Robust governance around these is essential for consistency and compliance. Product templates should align with the bank's product catalog, ensuring only approved and correctly configured products are set up in the system. 13.3 Data quality controls and reconciliations. High-quality data is critical. Implementations require real-time input validations to prevent errors, regular automated reconciliations between Loan IQ and other systems like the general ledger, and data cleansing processes to correct existing errors. Data stewardship assigns ownership for data quality to specific teams. 13.4 Operational risk scenarios and mitigants. Operating Loan IQ involves risks like manual error, system failure, integration failure, data breach, and regulatory noncompliance. These are mitigated through maker-checker workflows, redundant infrastructure, robust integration design, strong access controls, and ensuring system configuration aligns with regulatory requirements. 13.5 Audit readiness and evidence. Banks are subject to frequent audits. Loan IQ supports audit readiness by maintaining comprehensive audit trails of all transactions and data changes, providing auditors with necessary reports, and documenting all operational processes and system configurations to demonstrate that internal controls are effectively implemented. Chapter 14 Advanced structures and use cases. 14.1 Multi-currency, multi-borrower, multi-guarantor structures. Loan IQ is built for international finance. It manages currency conversions and multi-currency accounting. It can link multiple borrowers to a single deal, tracking their individual liabilities. It also records and tracks multiple guarantors, their guarantee amounts, and any specific conditions. 14.2 Project finance and infrastructure lending. Project finance deals are highly structured. Loan IQ can track the status of complex security documents, manage strict payment waterfalls, and model distinct construction and operation phases with different drawdown and repayment profiles. It also tracks debt service reserve accounts, which provide a buffer for debt service. 14.3 Leveraged loans and CLO reporting. Leveraged loans are extended to companies with high debt-to-EBITDA ratios and feature aggressive pricing and tighter covenants. Loan IQ supports these terms and provides the source data for collateralized loan obligation managers to monitor portfolios, perform compliance tests, and generate investor reports. 14.4 Club deals versus fully syndicated deals. Club deals are smaller syndicated loans arranged by a few banks. Fully syndicated deals are marketed to a wide range of investors. Loan IQ's capabilities for managing numerous lenders, secondary trading, and complex allocations are essential for these larger transactions. 14.5 Cross-border and booking model considerations. Loan IQ supports transactions across multiple jurisdictions, handling legal, regulatory, and tax complexities. It can also be configured to support various booking models, such as the agency, principal, or participation models, ensuring correct accounting and risk attribution. Chapter 15 Implementation, Migration, and Testing. 15.1 Target state design and roadmap. Implementing Loan IQ is a significant undertaking. It requires clearly defining the desired future state, identifying gaps between the current and target states, and developing a phased roadmap for implementation. A strong business case is also needed to justify the investment. 15.2 Data migration strategy. Migrating existing loan portfolios from legacy systems is one of the most critical and challenging aspects. This involves extracting data from disparate systems, cleansing and enriching it, mapping it to Loan IQ's object model, and utilizing specialized tools for bulk migration. Thorough reconciliation with source systems is essential to ensure accuracy. 15.3 SIT, UAT, and dress rehearsal. Rigorous testing is essential. System integration testing checks the end-to-end flow of data across Loan IQ and its integrated systems. User acceptance testing allows business users to validate that the system meets their functional requirements. A dress rehearsal is a full end-to-end simulation of the cutover process to identify any last-minute issues. 15.4 Cutover and early life support. Detailed planning for the transition from legacy systems is required, including timelines and rollback procedures. After go-live, intensive early life support is provided to quickly address any issues and ensure business continuity. 15.5 Continuous improvement and release management. Loan IQ implementations require ongoing management. This includes regularly reviewing processes for optimization, managing upgrades and patches through a structured release management process, and providing ongoing training and documentation for users. Chapter 16 Case studies and exercises. 16.1 Classic corporate term loan with A, B tranches. Scenario: Global Tech Incorporated needs $750 million for an acquisition. The lead arranger proposes a syndicated term loan with 2 tranches. Term Loan A for $400 million with a 4-year maturity and quarterly repayments, and Term Loan B for $350 million with a 6-year maturity and a bullet repayment. Exercise: Describe how you would configure this deal in Loan IQ, focusing on deal and facility setup, tranche configuration, and capturing lender commitments. 16.2 Revolving credit facility with multiple drawdowns. Scenario: Retailco Limited secures a $200 million 3-year revolving credit facility for working capital. It allows for multi-currency drawdowns in USD and Euro and has a 40 basis point commitment fee on the undrawn portion. Exercise: Outline the steps in Loan IQ to set up the facility, process drawdowns in different currencies, and explain how the commitment fee is calculated. 16.3 Project finance case. Scenario: Green Power Corporation is developing a solar power plant requiring $1 billion in project finance. The loan has a 2-year construction phase with capitalized interest followed by an 18-year operation phase. Exercise: Discuss how Loan IQ would manage the distinct phases, interest capitalization, and the payment waterfall. 16.4 Configuration exercises. This section provides step-by-step guides for the above case studies, along with expected outcomes and common pitfalls. 16.5 Common defects and how to fix them. Defects include incorrect interest calculations, often due to wrong base rate indices or margins. Lenders not receiving correct payments can be caused by incorrect allocations or bank details. Covenant breaches not being detected may result from misconfigured covenant setups or missing input data. Verifying configurations against facility agreements and reconciling with payment logs are key fixes. Chapter 17 Interview, UAT, and Certification Toolkit. 17.1 Role-specific question banks. This section provides sample interview questions for various roles. Operations questions focus on daily processing and reconciliation. Business analyst questions cover facility agreement interpretation and system configuration. Architect questions address integration patterns and data models. Support questions involve troubleshooting and incident management. 17.2 Practical scenarios. Scenarios for workshops and interviews assess problem-solving skills. For example, how to handle a drawdown request when a condition precedent is not met, or how to implement an amendment that changes the margin on an existing tranche. 17.3 Checklists for new deal setup. Comprehensive checklists ensure all critical steps and data points are covered during the setup of a new syndicated deal, minimizing errors and ensuring compliance. 17.4 Onboarding plan. A structured onboarding plan for new team members covers essential training modules, system navigation, and key processes. 17.5 Your personal learning roadmap. Guidance on how to continue developing expertise in syndicated lending and Loan IQ, including recommended resources, certifications, and career paths. This concludes our guide to Finastra Loan IQ and syndicated lending. We hope this audio ebook has been a valuable resource for your professional development.